Right now, shares of Moderna, ticker MRNA, are trading live at $23.84. That's a gain of 28 cents, or about 1.19% from yesterday's close. But that single number is perhaps the most misleading piece of data you will see all day, and it perfectly captures the trap that so many investors are falling into with this stock. The reality is that this stock gapped up in pre-market trading, opening at $25.24, and has been in a near vertical collapse ever since, hitting a low of $23.83. This isn't a story of a stock gaining ground. It's the story of a stock that tried to rally on what looked like good news and was aggressively sold off by the market. This is the definition of a bull trap, and it's happening right before our eyes. The expectation this morning, fueled by the company's third-quarter earnings report, was one of relief, maybe even optimism. The company posted a loss of only 51 cents per share. That sounds bad, but Wall Street was bracing for a loss of over $2.15. They crushed that expectation. They reported revenue of $1.02 billion, smashing the consensus estimate of around $904 million. On paper, this looks like a huge beat. You would expect the stock to be soaring, to be the top performer on the Nasdaq. And for a few fleeting hours before the bell, it was. But now we're staring at reality. The market is telling us in no uncertain terms that it does not care about the backward-looking Q3 beat. It is looking forward, and it is terrified of what it sees. The common belief, the narrative you'll see pushed on various investing sites and discussed in trading forums, is that Moderna is a post-pandemic washout. The story is that this was a one-hit wonder, a company that captured lightning in a bottle with its COVID vaccine and is now fading back into obscurity, destined to burn through its massive cash pile. Many retail investors, perhaps those using platforms like the Robinhood app or SoFi Invest, see the stock price down near 52-week lows and think it must be a bargain. It's Moderna, the company that saved the world, trading for less than $25 a share? It feels like buying Apple stock in the early 2000s. The expectation is that the worst must be over, that the market has overcorrected, and that this Q3 earnings beat is the starting gun for the next leg up. But the professional desks, the large funds managing Fidelity wealth management accounts, and those using sophisticated tools from interactive brokers are reading a different story. The reality is that today's intraday price action is a massive vote of no confidence. The market isn't looking at the 51-cent loss, it's looking at the collapsing guidance and the crumbling pipeline. Let's dissect what is actually happening. The reason the stock is being liquidated today, despite the headline beat, is found in the forward-looking statements. Management narrowed its full-year 2025 revenue forecast to a range of $1.6 billion to $2 billion. The midpoint of that range, $1.8 billion, is below what analysts were already projecting. So while Q3 was better than feared, the company is implicitly telling us that Q4 and the year ahead are worse than expected. This is the classic beat and lower scenario, and it's poison for a stock. Furthermore, the market is finally digesting the catastrophic failure of what was supposed to be the next big thing, the congenital CMV vaccine. Just a few weeks ago, Moderna announced that their Phase 3 study for this vaccine failed to meet its primary efficacy endpoint. This wasn't just a minor research setback, this was a multi-billion-dollar opportunity, a key near-term growth driver that was supposed to prove Moderna wasn't a one-trick pony. And it failed. That failure has created a massive hole in the company's future growth projections, a hole that a 51-cent earnings beat simply cannot fill. This brings us to the pipeline, the very thing that is supposed to justify any online investment in a biotech company. Beyond the CMV failure, the launch of their first non-COVID product, the RSV vaccine, MRNA, has been anemic. Today's report showed it brought in a paltry $2 million in sales. This is a market where competitors are already entrenched. This weak debut sends a chilling message. Even when Moderna gets a product to market, it may not be able to compete effectively. This isn't like the pandemic where they had a wide-open field. This is a street fight, and they just showed up with very little muscle. The trading volume today is heavy, already approaching 7 million shares just over an hour into the session, as investors who bought the pre-market good news are now scrambling to get out. This is capitulation. We are testing the 52-week low of $23.15. If that level breaks, there is very little technical support below it. The stock is in a confirmed falling trend channel, and today's action is just reinforcing the strength of that downward momentum. This is the kind of chart that keeps self-investing retail traders up at night, the ones who bought at $50, $75, or even $100, believing the dip was temporary. So, what does Moderna actually do, and how did we get here? Moderna, as we all know, is a biotech company that specializes in messenger RNA technology. This technology essentially teaches the body's cells how to make a protein that can trigger an immune response or correct a genetic problem. For a decade, this was largely theoretical, a high-risk, high-reward platform. Then the pandemic hit. Moderna, in a historic feat, designed, tested, and commercialized its COVID vaccine, Spikevax, in less than a year. This sent the stock from a relatively obscure name to one of the most famous companies in the world, with its share price exploding by thousands of %, and its market cap swelling to rival pharmaceutical giants. The company was flooded with tens of billions of dollars. The expectation was that this cash hoard would be used to fund a sprawling pipeline of other mRNA-based treatments for everything from cancer and heart disease to flu and other rare viruses. It was supposed to be the dawn of a new age in medicine. But the reality has been far harsher. As the pandemic subsided, the demand for COVID vaccines collapsed. Governments stopped placing massive orders. The market shifted from a public health crisis to a normal commercial one, and Moderna's revenues fell off a cliff. The stock has been in a brutal 2-year bear market, erasing the vast majority of its pandemic-era gains. Institutional ownership has been shaky. While some funds have been adding to their positions on the cheap, recent data showed a net decrease of 58 institutional owners last quarter. Analysts are completely divided, which is why platforms like Fidelity shows a consensus hold rating. This isn't a buy, and it's not quite a strong sell, it's a statement of profound uncertainty. The hold rating, which covers nearly half of all analysts, is just a polite way of saying we have no idea. The 31% of analysts with a sell rating are the ones who believe the post-pandemic revenue cliff is real and the pipeline is not developing fast enough to replace it. They look at this company not as a growth story like Nvidia stock or Tesla stock, but as a melting ice cube of cash. Now let's talk about the future, because that's what today's entire sell-off is about. What is the bull case from here? The bull case rests on two things: the remaining pipeline and the cash. The company does have some bright spots. They recently reported positive Phase 3 results for their standalone seasonal flu vaccine, MRNA 1010. They have also filed for approval for their combination flu and COVID shot, MRNA 1083. If these are approved, and more importantly, if they can successfully commercialize them against entrenched competition, that could provide a new stable revenue floor. Then there is the oncology program, specifically the cancer vaccine being developed with Merck. That is now in Phase 3 trials. This is the high-risk, high-reward lottery ticket. If it works, it completely changes the narrative for the company, but "if" is doing a lot of work in that sentence, and a payoff is years away. Finally, there's the cash. The company ended the quarter with $6.6 billion in cash and investments. They are aggressively cutting costs, saving $0.7 billion in expected operating expenses this year alone. They are aiming to break even by 2028. The bull case is that this cash provides a long runway to let the rest of the pipeline develop. But the bear case is what the market is pricing in today. The bear case is that the CMV failure is a sign of a systematic problem, that the mRNA platform may not be the silver bullet for all these other diseases. The bear case is that the anemic RSV vaccine launch proves the company lacks the commercial savvy to compete in a normal market. This is the case that they will simply burn through their $6.6 billion cash hoard, chasing failed trials and lackluster product launches, with revenues never recovering to a level that justifies even this beaten-down valuation. This is the tension at the heart of mRNA. This is why a simple online investing account, whether it's an individual brokerage at Schwab Intelligent Portfolios or a SoFi trading platform, doesn't give you the full picture. You see a